Welcome back to another lecture of the Ethan Trades Mentorship. In this lecture, I will be covering Candlestick Anatomy, as understanding this is the absolute beginnings of understanding how price action on a chart works. There are several types of representations of price on a chart, each offering a different perspective on market movements. Personally, I only use Japanese candlestick charts, and in this mentorship, that's all I'm going to be focusing on. So I'll have them all listed here on the slide, but once again, the only type of chart we'll be using and focusing on is the candlestick chart. The line chart, we will refer to that a little bit from time to time just to break down the concepts a little further. But overall, once you understand how price action works, you will no longer need the line chart. The line chart's just for beginners. If you're an absolute beginner, the line chart may assist you in learning price movement, so I've decided to include this in my explanation. Just as any two-dimensional chart, there is an x-axis and a y-axis. The x-axis represents time, and the y-axis represents price of an asset. A line chart connects opening prices, highs, lows, or closing prices of a candlestick with a continuous line. So whenever you look at a line chart, you're really just looking at data derived from a candlestick chart. It provides a simple and clear overview of price trends over time and can be great for finding dealing ranges, which is a concept that I will introduce in a later lecture. So once again, on any chart, on the bottom, you will see that there is a x-axis, which is delineating time, and then the y-axis here is delineating price. If you're more experienced, you've probably heard of candlestick charts already. This will be the type of price that we will be using throughout this entire mentorship. And the reason we use candlestick charts is because it provides a lot more information than a line chart, making it easier to do analysis on markets and basing probabilistic price movements based on recurring patterns that we find in the charts. In a candlestick chart, each candle represents price action of an asset over a specified period of time. Candlestick anatomy refers to the components and structure of a candlestick on a price chart. Candlesticks are a popular way to represent price movements in financial markets, providing insights into the open, high, low, and close prices for a specific time period. The open, high, low, and close are the four key price points in a candlestick. Each candlestick provides information about the price movements during a specified time period. The opening price is the first price at which a trade occurs during the time period represented by the candlestick. The high price is the highest price reached during the represented time period, and the upper or top wick of the candlestick extends from the top of the body to the high price. The low price is the lowest price reached during the time period. The lower or bottom wick of the candlestick extends from the bottom of the body to the low price. And then last but not least is the closing price is the last price at which a trade occurs during the represented time period. When we are bullish, meaning that we expect price to go upwards, we look for an open, low, high, close candle. And when bearish, meaning that we expect price to go downwards, we look for an open, high, low, close candle. By the represented time period, it means that the price data encapsulated in the candlestick pertains to a defined duration of time. In financial markets, candlesticks are used to visualize and represent the price action over discrete time intervals. When looking at charts, we are given the option to look at multiple time frames. When on the daily time frame, each candle represents the price action that occurs over the period of 24 hours. When on the hourly time frame, each candle represents the price action that occurs over the period of 60 minutes, and so on and so forth. The time frame you select is how much time one candlestick represents. Putting the concept of time and price together, the start time of each specified time frame will be the open price, and the end time of each specified time frame will be the close price of the candle. The high and low of the candles are the highest and lowest prices reached within the represented time period. And so to break down the schematic I have right in front of you guys, the colored portion of the candle is the body of the candle, and the lines that stick out of the top and the bottom of the body are the wicks of the candle. So this entire thing makes up one candle. The colored portion is called the candle body, and the lines that stick out from the top and the bottom are the wicks. And so here is a candlestick broken down, where when we're bullish, in this case, I have my bullish candles in blue, or up candles in blue. You'll have an open, low, high, and then close candle. Whereas if you're looking for a bearish candle, which means we're expecting a down close candle, we have an open, high, low, and then close. And so if you look at the little schematic I've drawn to the left of the bullish candle, this is to define lower time frame price action within this candle. So let's say this candle is the daily candle, meaning it's 24 hours of trading right here. Well, when you break that down to the lower time frame, let's say this is the 15-minute chart, this is the price action that you're going to see on a line chart. And so here, once again, if you pay attention, you have the open, right? And then it trades lower, which creates the low, starts trading higher, creating the high of the candle, which is why this wick is here, and it closes, which is why the body of the candle is here, right? And vice versa. The bearish candle opened here, which is why the body of the candle starts from this line right here, and then it trades higher, creating the high of the candle, which is this top wick, and then starts trading lower until it eventually creates the low of the candle, which is the bottom wick, and then it trades back up a little bit higher to create the close, which is why the body of the candle finishes over here. And so that's what creates the body of the candle, is the open and the close. The high and the low are the wicks that are created by the highest price has been at and the lowest price has been at within this time period. So if this was a daily candle, once again, within 24 hours, the highest price reach was this level right here. The lowest was this level right here. And it closed, let's say this is midnight, and then this is midnight again. So 24 hours. And then you just have a candle opened at midnight, closed at midnight at these price levels. Before moving on, I just wanted to quickly cover time frame abbreviations as well. And so a capital Y refers to a yearly time frame, a capital M refers to a monthly time frame, a capital W refers to a weekly time frame, a capital D refers to a daily time frame, a capital H refers to an hourly time frame, an lowercase m refers to a minute time frame, and a lowercase s refers to the seconds time frame. And so in this chart, we have the weekly time frame. The time frames are found at the top left of your TradingView chart. In this case, I've kind of just screenshotted it and pasted it on the slide. But when you go on your chart, it will be at the top left of your screen. In this time frame, each candlestick represents one trading week. So that would be Monday, Tuesday, Wednesday, Thursday, and Friday. The highlighted candle that we will be looking at for this example is a bullish candle, meaning price went upwards from the open to close. In this case, we look for an open, low, high, and then close. And so this is going to be the candle that we're dissecting to study candlestick anatomy. Zooming in on the weekly candle, I have now dropped down to the daily time frame. The gray box that I have drawn out here is the same gray box that we have on the higher time frame right here. So once we drop down a time frame, this candle right here represents one full trading week, which is Monday, Tuesday, Wednesday, Thursday, Friday. So when we drop down to the daily time frame, now we have 5 candles that make up that one larger candle, and that's this gray box right here that you saw on the higher time frame. So this candle right here is Monday, this one's Tuesday, this one's Wednesday, this one's Thursday, and then this one is Friday. Each candlestick on the daily time frame represents 24 hours each. They begin from 6 p.m. EST and end at 6 p.m. EST. Monday was a bearish candle, so we look at it as an open, high, low, close candle. Tuesday was a bullish candle, so we look at it as an open, low, high, close candle. Wednesday was a bearish candle, so we look at it as an open, high, low, close candle. Thursday was a bullish candle, so we look at it as an open, low, high, close candle. And lastly, Friday was a bearish candle, so we look at it as an open, high, low, close candle. I hope this gets the idea across for what we are looking for in terms of candlestick anatomy, but I will further break this down. So right now, referring back to the chart you have in front of you right now, we're breaking down the higher time frame candle. So this is the weekly candle, right? Because it's a bullish candle, we're expecting that it's an open, low, high, and then close candle. And so that's what we're studying here. If you go down to the daily chart, now you have Monday, Tuesday, Wednesday, Thursday, Friday, where you have an open, right? So this is the weekly open, this dotted line right here. Price trades lower, creating the low of the week, and then starts trading higher on Wednesday, creating the high of the week. And then you can see on Friday here that we had the weekly close. So in this case, we had the open, low, high, and close of the weekly candle. So now we're going to be breaking down each of these daily candles just to get the point of fractalization across. Dropping down once again into the hourly chart, we can see that the days of the week are now broken up into even more candlesticks. Understanding that time is fractal is crucial, and by utilizing this concept, we will be able to trade short-term with a long-term vision in mind. This is called top-down analysis and will be taught in a later lecture as well. On the hourly chart, once again, each candle represents what the time frame is, and in this case, each candle would represent 1 hour of time each. So each of these candles you see here represent 1 hour of time. So this first candle here is 6 p.m. EST. That means the next one's 7 p.m. EST, 8 p.m. EST, 9 p.m., 10 p.m., 11 p.m., 12 p.m., right? So on and so forth. And so that's how we pretty much go about it. And once again, this is just representing and breaking down that weekly candle that we were initially looking at. This gray area that we're still in is just the study candle. And so here you have Monday. It starts from Sunday 1800 EST, ends at Monday 1800 EST, and then that's when Tuesday's trading day starts, and then so on and so forth. And here I've pretty much included the timestamps for you guys at the bottom. On the right here is the price scale once again. And you can get a really closer look here because we're breaking down the candle even more, where this candle right here is the weekly open, right? And we have open, low, where price trades lower first, low of the week, and then starts trading higher, creating high of the week on a Wednesday, and then weekly close on the Friday. So now that we're on a lower time frame, such as the 1 hour, it makes a lot more sense. That's all I have for this lecture, and I encourage you guys to head into your TradingView charts to study this further if you haven't fully grasped the concept of candlestick anatomy. See you guys in the next one, and as always, have a great day.